Welcome back. The price of crude oil has collapsed to four-year low territory as traders react to news that OPEC Plus is increasing production quotas at a time when there are big questions about global oil demand. Our next guest remains bearish on the near-term future of oil. Let's welcome Reid I'Anson, an economist at Kpler. He joins us from Houston. Reid, thanks a lot for joining us. It seems like even to the non-expert, there are some pretty substantial headwinds to crude oil. OPEC Plus, everybody knows, is raising quotas and may do so again, putting more oil on the market. It's a market share situation that you can do a better job than I of explaining. And on the demand side, we have big questions about Chinese economic growth, global economic growth, a situation made worse perhaps by global tensions, trade tensions around the world. Tell us what your view is on the supply-demand fundamentals for crude oil.
Yeah, it's kind of a double negative if you're looking at oil markets right now. Of course, if we focus on the demand side first, coming into this year, we were expecting global growth at 3.3 to 3.4% annualized. We have had to revise that back quite a bit. We're thinking growth closer to 2.8%. So of course, that is weighing on our expectations for oil demand this year. And then again, if you shift to the supply side, OPEC Plus bringing on additional barrels, no doubt puts additional pressure on prices. We think that the overall market balance this year for the oil market right now is in net surplus of around 250 to 300,000 barrels per day. So again, weakening demand expectations with additional supply certainly weighing on the outlook for oil prices here.
Let's dwell for a moment on why OPEC Plus is raising quotas at a time when demand is sluggish. This amounts to Saudi Arabia trying to punish other OPEC Plus members who are who are exceeding their production quotas by putting more oil on the market and deliberately pushing the price down. Is that a fair depiction?
I think a better way to think about it is one of compliance. OPEC Plus, of course, has had several countries that were struggling with compliance issues, and thus you had other members of the group saying, look, we want to pump more oil right now. Of course, OPEC has been very disciplined at keeping supply off the market the last year or so, and we just kind of got to a place where the OPEC members, as a collective, said, look, compliance isn't great across some countries, and so we need to go ahead and move to loosen it up here. Of course, as you mentioned, that very much has a downward impact on oil prices. And again, we're kind of watching that Brent price test 60. We'll see if we can push through that key technical level here.
What is your target, if you've got one, on West Texas Intermediate crude by the end of this year?
We think that it's going to probably continue to trade in the high 50s. Kind of where it is right now. Again, that 55 to 60 level looks like a reasonable target. However, if we're thinking about risks, it's absolutely to the downside. And so if we do see a big move in oil prices one way or the other, it will likely be to the downside, and we will look to test that $50 per barrel level. But our official view at Kpler for now is that we kind of stick to that 55 to 60 range. But again, keeping in mind, the risk is absolutely to the downside here.
And what does, let's say, $55 crude oil mean to the U.S. shale producers who, at least at some periods in the fairly recent past, have been important swing players in the market?
Yeah, it absolutely has implications for production. We've already scaled down supply expectations for U.S. output this year by roughly 120,000 barrels per day and another 170 KBD next year from initial expectations. So again, the weakening in price that we've seen is absolutely having a downward impact on output. Keep in mind that, again, a lot of the impact of a weakening price will especially start to show next year as firms plan ahead and make capital expenditure decisions. But again, we've seen a number of oil companies within the shale patch just with their recent quarterly reporting starting to indicate a cutback in capital expenditure here. So again, pretty consistent scaling down in U.S. production expectations, anywhere from 120 to 170 KBD over the next 18 months.
Let's move to gold. You cover gold as well. A completely different story there. A record-breaking year in 2025 for gold has plateaued somewhat over the past couple of weeks. What is your outlook on gold?
Look, our recommendation is anytime we get a sell-off in gold, take a long position right now. And a lot of this is just driven by the fact that a lot of folks are looking to diversify away from the U.S. dollar, given the chaotic nature of economic policy out of the White House. We think that this is going to continue, right? So again, anytime you get any kind of sell-off in gold, we're recommending you take a buy position here. And again, even though U.S. yields have risen the last week or so, we've still seen that upward push in gold price even today, right? And again, this really sticks to this narrative that people are looking to diversify away from USD.
And what about central banks? That's been a big factor in both the supply-demand equation and in terms of sentiment as well. When other investors hear that central banks are buying gold, they pay attention. Do you expect that trend to continue?
Yeah, absolutely. I mean, it's been a key driver of the gold price over the last year or so. And again, this trend will absolutely continue, not only in emerging markets, but across your large developed central banks as well. I think that gold demand will remain in place.
Do you follow silver at all?
Not too closely, but again, I think silver will be just another good alternative for folks who are looking for that USD diversification play. So again, I don't think that silver will necessarily keep up with the rally we've seen in gold. But again, it's another good opportunity if you're just looking to get out of USD exposure.
Reid, thank you so much for this conversation. That's Reid I'Anson. He's an economist at Kpler. Let's take a look at the markets before we turn ourselves over to our colleagues at Bloomberg Television. There's the S&P TSX Composite Index, essentially flat right now, down slightly, but faring better than the U.S. indices, as we'll see in just a moment. And if you look at the shape of the line, you'll see that the rally that we've seen since early April, since the end of week one in April, has been almost enough to bring the TSX Composite back to where it was before in very early April. The index, along with North American indices, plunged very steeply. Here's a look at Suncor. Suncor reports earnings after the close of trading today. It'll be interesting to see how lower oil prices in the first quarter affected the results at Suncor. The oil equities still have their fans. They still say that many of them say that these companies have adopted capital discipline, that they are not producing more oil simply for the sake of it, and they're very much committed to either buying back shares or raising dividends. So we'll see what Suncor has to say after the bell today, and we'll bring those results to you first thing in the morning on the street here at 8 a.m. Eastern Time. Barrett Gold also reports results. I believe those results are coming tomorrow morning, early tomorrow morning. We'll have John Ng with us tomorrow on the street. He's a gold expert, and he'll take us through this set of results and others. And he'll also explain what he looks for when he takes a close look at a set of quarterly financial results from a gold-producing company. Here's a look at U.S. markets. You see a negative picture there. It's actually deepened somewhat since the last time we looked. The S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite all down by about a percentage point or so. They've had a good week, but a negative day yesterday and today, and they're down on a year-to-date basis as well. Well, that